from next month, officially this is the case, and I think it's probably already de facto the case, China is restricting the licensing of exports, silver exports, out of China. And the reason for this is quite simple. It recognizes that it can no longer control the price, and therefore it needs to retain as much silver as possible within China, because this is becoming, I mean, they will know that the price has got to go a hell of a lot higher. But the problem this gives them, I mean, there is very little evidence of that yet. What we do see is that there has been an increase in speculative interest in the gold futures market, on COMEX. It hasn't been excessive at all, which tells us that this is very much a marginal thing. Um, I think what we have, if we look at it, I think in a sort of greater context rather than just supply and demand in the market and so on and so forth. What gold is reflecting is it is reflecting a lower purchasing power of the dollar, not just now, but anticipated in 2026. Now, this is interesting because, so far as I'm aware, the mainstream media, mainstream institutional investors aren't talking much about inflation in 2026. I mean, they see the economy stagnating, and if you're a Keynesian sort of thing, in other words, ignorant of economics, I'm sorry to say, then you would think that stagnating economy basically means less demand for goods, and therefore the prices of goods are unlikely to rise. Best case sort of thing. Could even fall, which would justify further Fed intervention. This is the Keynesian approach, because they dismissed something called Say's law, which basically says that, when it comes to production, production basically balances demand. If the demand drops, people get sacked on the production side. So production drops. So they go in sort of lockstep. Now, in a modern economy, you can't really say that's true, but as a general principle, it should be a guiding light to anyone trying to understand the relationship between a recession in the economy and the effect on prices. So I think that's the important point. Gold is discounting, I think, what's likely to happen, what the smart money sees happening to the dollar in 2026. In other words, the purchasing power of the dollar goes down, and the nasty surprise for everybody will be inflation goes up, inflation in the form of consumer prices. It will also go up in terms of commodity prices. I mean, we're already seeing this with copper. We're seeing it with precious metals, which most people regard as a sort of special case. But the broader commodity complex is bottoming out in terms of price. And I think that when you see that, then really what you're seeing is the purchasing power of a fiat currency declining. So it's starting. It's not evident at the consumer price level yet, but it is definitely starting. And on top of that, of course, you've also got the impact of Trump's tariffs, which are, I mean, they are uncertain in terms of their quantity, but the one thing that is absolutely certain is that they will drive up consumer prices in 2026. Now, quite a lot of Trump supporters say, well, there's been no evidence that consumer prices will be driven up by tariffs. It will be the producers who take it on the nose. I mean, they're ignorant. That's not the case. They don't take into account the Cantillon effect, if you like, that it takes time for these prices to work through to consumer level, but they will work through. So, in terms of gold, I think at the moment it's a sort of very professional, call it professional. Central banks, sovereign wealth funds, not in the Western capitalist system, if you like, basically protecting themselves against a decline in the dollar. I think there are some institutions in America who are beginning to understand this. I mean, I have a number of followers in these institutions, and I mean, I've been banging the drum on this one some time, and I'm sure they do understand it. Some of these people are actually quite large players too. So there is, I think, a sort of awareness, but it's not been translated yet in the form of a wider public recognition, if you like, of what's going on. The widest public recognition of what's going on comes at the end of a fiat currency's life, because it's really in the last 6 months or so when prices have been rising and rising and rising. Governments have tried to stop prices rising by putting in price controls, all that sort of stuff, and it all fails. Only then do people actually wake up and say, it's not prices going up, it's the currency going down. We've got to get rid of the currency, and then the currency is completely doomed. That happens at the end of life, as it were, for a fiat currency. We will see it, I think, probably by, well, I don't know, sometime in 27. Could be earlier. I don't know. I mean, we've got no idea how quickly these things might evolve. In the dollar's case, it could actually be a lot quicker than anybody really thinks.
Many analysts assume a slowing economy automatically suppresses inflation. That belief rests on outdated economic models that ignore how production adjusts alongside demand. In reality, reduced output often leads to supply constraints, not falling prices. Add tariffs into this equation, and inflation risks grow sharper. Trade barriers raise costs throughout supply chains, even if the impact takes time to reach consumers. Despite claims that producers will absorb these costs, history shows they are passed along. Gold is responding not to today's data, but to tomorrow's consequences: higher prices, weaker currencies, and renewed central bank intervention.
I think that is a very good point. Back in 2011, basically what happened was that the Fed wrote an open-ended check to rescue everything from the Great Financial Crisis, what was called the Great Financial Crisis. I don't know what they'll call it after the next one, because the next one's going to be quite a bit greater. But anyway, now following that, the inflationary implications of that, in other words, the implications on the purchasing power of fiat currencies, was obviously negative. And for that reason, gold rose. I mean, having fallen from $1,000 before all this happened in 2000 and early 2008, late 2007, fell down to about $670 and then rallied subsequently to 920. That was a peak, I think, in September 2011. Now, that move basically reflected the effect on the purchasing power of the dollar from the Fed's open-ended check, if you like, the rescue. And not only that, but the ongoing problems that we had in Europe in particular. You had the Cyprus banking crisis collapsing. You had Greek banking crisis collapsing. We had everybody started talking about the pigs, Portugal, Italy, Greece, and Spain, and so on. So there was a lot of uncertainty around. There was big credit risk, if you like, in these markets, but not in the US, in the US government bond market. The level of debt was considerably lower than it is today. The other factor I would say is that in those days, China was less of a player in the international scene than it is today. The sort of concept, virtually very few people had heard of the Shanghai Cooperation Organization. And the only reason we heard of BRICS was because an ex-Goldman Sachs economist, who's British, came up with the acronym for these emerging economies. At that stage, they weren't emerging economies as part of the Chinese/Russian sphere of influence. They were just emerging, BRICS. It was, it was Brazil, India, China, South Africa. So you had, that's what it was. But that is transferred into, if you like, a wider pseudonym for the global South. All those countries which are either joined into an official relationship with China in terms of trade, or alternatively want to join or are interested in joining as soon as they feel that America won't come and beat them up for joining, sort of thing. So the thing has changed the world has changed in that sense. China is now, in terms of real GDP, in terms of sort of adjusted for prices and all the rest of it, China is now larger than America. So I think that's an important difference. Now, not only that, but China has put in place um, protection for the yuan in the case of a collapsing value of the dollar. Because, I mean, the Chinese know what's going on. I mean, they're making the same analysis that I am. This is the end of the fiat currency era. Now, their yuan is a fiat currency, so they've got to protect it. And this is why the Shanghai Gold Exchange at this juncture in 25 open vaults in Hong Kong and also Saudi Arabia, where gold could flow in and flow out exclusively against Chinese yuan. The one thing they haven't done is fixed a rate yet. I think they will fix a rate to protect the yuan from when the dollar really starts sliding. So that's something that we could see by the end of 2026. And I think those, if you like, it's those factors which make the difference. The idea that the authorities can come in and bang the market, knock the gold price down from, I mean, at that time it went down in 2011. The high was 1924, I think, intraday, and it went all the way down to something like 1040 by 2014-15. The idea that the American authorities in particular can mount an attack on the gold price and drive it down from the current level of 4,400-ish, so that it doesn't become a problem for them ever again. These are very different conditions. The big difference, I think, is China and also the level of government debt, which is completely unsustainable. America this time is going into a debt trap. Last time it wasn't going into a debt trap. It had room for maneuver. I mean, the Fed could print up to $14 trillion worth of credit to rescue the banking system and the insurance companies and the derivatives markets and all the rest of it, because it had room to do so. It doesn't now.
The most active buyers of gold today are not retail investors, but central banks and sovereign institutions, particularly outside the Western financial system. These buyers are positioning defensively against long-term currency erosion. While public awareness remains low, large pools of capital are already adjusting. Historically, mass recognition only comes late in a fiat currency's decline, when price controls fail and inflation accelerates. By then, it is too late. Gold's role is not speculative, it is protective. What we are witnessing now is the early phase of that transition before the public narrative changes.
There's no doubt about it. It is an industrial commodity. It has historic roots as money, but the central banks aren't buying it as monetary reserves, that is for sure. So the reset, as it were, which everybody talks about, which basically will be China sorting out its currency, making sure that the purchasing power of its currency doesn't slide along with the rest. That's going to be against gold, not against silver. So silver is very different. The demand for silver has just gone off the charts simply because you've got the photovoltaic cell industry, and really, as part of India's environmental credentials to offset the use of coal-fired power generation. I mean, they've opened an enormous number of coal-fired power stations. They're subsidizing businesses, the big conglomerates like Reliance Industries, to go and make photovoltaic cells. And so the production of these things in India is beginning to really ramp up. So where does the silver come from? The other question we have to ask is that the new Samsung car battery, I mean, motor vehicles consume something like, the batteries consume something like 25 grams or something of silver. The new generation of Samsung car batteries, which don't use lithium but use silver carbon anode batteries, they consume something like a kilogram. Now, these are the new batteries, and they give you more range and they charge quicker. I mean, so this is going to go into luxury cars by the end of 2026. So you can see that any manufacturer in the electronics industry, in the environmental industry, in the motor industry, has got to go up there and grab as much silver as they can because there isn't very much around. I mean, mine supply is roughly 820 million ounces a year, about 25,000 tons. Of that, almost 70%, somewhere between 65 and 70%, comes not from silver mines, but from other mining activities, copper, zinc, lead, tin, whatever. So, um, you know, they're not going to increase in terms of supply. That is for sure. So the supply is pretty fixed. You've obviously got scrap silver, but scrap silver is probably declining as an element in the whole thing. I mean, we've found in India, for example, that rising prices have not shaken out scrap silver, um, which was, I think, generally unexpected. You would think that ordinary people, with bits of silver here, there, and everywhere, sort of get it together and then take it down to the local shop and sell it for, but they don't want rupees. But whatever. I mean, we can speculate why they don't want rupees. I think we can guess why they don't want rupees. The rupee hasn't exactly had a glorious history as a fiat currency. So, supplies are very limited. Now, in the past, China has actually controlled the market because not only is it the second largest nation by mine output, but also it's been importing doré and other base metal ores for refining. And so is the largest refiner of silver in the world by long. So it's controlled the market and it's managed to suppress the price for a long time. Then President Trump came into the scene and he started monkeying around with tariffs on China, threatening them this, threatening them that, 150% tariffs and so on and so forth. So what did China do? Turned around and said, well, if that's your game, we'll stop supplying you with the things you need. And they started with the rare earths.
Gold's last major peak followed the global financial crisis, when central banks unleashed massive liquidity. That surge reflected monetary expansion, but conditions today are far more severe. Government debt levels are dramatically higher, leaving policymakers with little room to maneuver. At the same time, global power has shifted. China now rivals, and in some measures surpasses, the U.S. economically. Unlike in 2011, China has built infrastructure to protect its currency, including gold-linked settlement systems. This limits the ability of Western authorities to suppress gold prices as they once did. Structural power has changed.
From next month, officially this is the case, and I think it's probably already de facto the case, China is restricting the licensing of exports, silver exports, out of China. And the reason for this is quite simple. It recognizes that it can no longer control the price, and therefore it needs to retain as much silver as possible within China, because this is becoming, they will know that the price has got to go a hell of a lot higher. But the problem this gives the markets is that where does India go for its silver? Well, it goes to COMEX and it stands for delivery. I mean, this year so far, just under 15,000 tons of silver. Roughly 60% of global annual mine supply has been stood for delivery on COMEX alone. And then you got London. I mean, this is a huge, great liquidity issue between the derivative markets, where silver is traded and obligations are out there in many multiples, several hundred times the availability of the underlying silver. And that's coming to an end. And as that comes to an end, where does the price of physical go? Well, how high? It's going, it's a good classic commodity squeeze. And we're seeing the same thing, basically. I would argue to a lesser extent in platinum and palladium, particularly platinum. Which, I mean, in that case, I think the platinum price has been suppressed for a very, very long time. You've got very few manufacturers, mining entities which produce any reasonable quantities of platinum and palladium. Uh, Traditionally, it's been South Africa and Russia, and Russia is sanctioned. What good does that do? So the whole thing is this is a mess. And I'd throw in something else about these metals. I mean, silver I regard as operating as a base metal, if you like, with some sort of psychology about, being a form of money on top. Um, the underlying situation is that if you look at the value of base metals, valued in gold, not in fiat currencies, because the value of everything in gold basically is pretty constant over long periods of time, fluctuates a bit, but not nearly as much as it does in fiat currencies. What's happened is that, a sensible basket of these base metals is worth roughly 18% of what it was in the year 1900. In 2008, since then, I mean, it's because I was calculating it for copper, the value of copper since 2008 measured in gold is 8% of what it was then. But this is disguised by the falling purchasing power of the dollar. I mean, you look at the dollar chart of copper and it's going up and it's breaking into new high ground and all the rest of it. But it's just picking up off the bottom in gold. This is the importance of something I was saying earlier, and that is that gold is front running. It is anticipating what's going to happen to the dollar in 2026. It's anticipating as far as it can see, which I don't know. Could be only 3 months, 6 months, might be a year. We just don't know. But you can see now that if the price of copper is going to normalize itself in gold, then that is going to go up in gold 4 or 5 times. How much will it go up measured in declining dollars? I mean, 5 becomes your minimum. Don't be surprised to see it over 10 times. Don't be surprised to see it over 20 times. What I'm trying to say is that the whole of the fiat currency regime has distorted the relationship between money. By that I mean legal money, which is gold, and commodity values, and that's going to correct, and it'll correct big time.
Silver's story is even more extreme. Unlike gold, silver is primarily an industrial metal, and demand is accelerating. Solar energy, electric vehicles, advanced batteries, and electronics are consuming silver at unprecedented rates. New battery technologies alone could multiply silver usage per vehicle, yet supply remains constrained. Most silver is mined as a byproduct, meaning production cannot easily expand. Meanwhile, China is restricting silver exports, forcing buyers like India to seek physical delivery through futures markets. This creates mounting pressure on derivative systems backed by limited real metal, setting the stage for a classic supply squeeze.
Yeah, it's bound to increase because of the nature of it. I mean, the simple advice I'd say is don't try and trade it. You know, there are bigger people than you running this market effectively. Now, whether it's Reliance Industries in India needing to buy 20,000 tons or whether it's JP Morgan acting either as a principal or on behalf of its customers trying to knock the price down, you are a lot smaller than they are, and they will take you to the cleaners if you try and trade it. And in a bull market like this, if you take your profits, you'll never get back in. You'll be chasing your tail. So don't try and play that game. As far as the market, this market doesn't operate like a stock market. In a stock market, which is regulated investment, incidentally, you've always got buyers and sellers. There's always depth, if you like. So if the value of something like Nvidia or Microsoft increases, there will come a point where people take profits and they will sell into the market. So you've got that sort of liquidity. So what happens basically is that as prices rise, then the sellers come in. So demand, if you like, balances supply at a higher level. Now we all understand that because we've all seen the graphs that that have been shown you in high school. Um, but this is very, very different. We have a situation where that's reversed because the higher the price goes, the fewer sellers there are. You do not have investors in this market. You only have industrialists. Yeah, I mean, okay, you might have um, some ETFs, but that's a relatively minor thing. The big players in this, for example, are China. They've been very, very big. They've just withdrawn from the market, which is why this crisis, if you like, in the derivatives market has come about. I don't know how much silver, if any, America has. They've declared it as a critical mineral, which basically means that they're unlikely to supply markets unless there is great pressure on them from US Treasury to do so. It's a very different situation. So with that lack of liquidity, because everybody tends to be the same way, they're either all sellers or they're all buyers. And when things are rising, they're less inclined to sell, including mines, hedging the position. I mean, if you look at the position of mines, the silver mines, typically they have wages to pay. So when they have doré shipped off the site and they're paid for it, then they pay the wages and they pay the energy bills. Of course, energy is a major, major part of the cost. But now that the price has gone up, they're not in the sort of situation where they have to sell immediately. They don't have to go and, if you lock in the price on COMEX by selling futures, which they would eventually cover, if you like, by delivering into the market. Or once they've delivered it, they can then close their short position. That's gone now. I mean, okay, there's some evidence of it there, but it's diminishing, and this is putting huge, huge, great pressure on the shorts. And I think the shorts are going to be even more squeezed than they are now, and they're desperate to cover. Now, where there is cover, they've covered derivative obligations, which are standing for delivery, with long positions, say in London, which are in derivatives. But the problem is that both sides, longs and shorts, are being drawn down by the encashment into physical. And there is no physical there. The physical is just not there. So, I mean, silver, it would be silly to put a price on it, but I mean, silver could triple or quadruple from here quite easily in these conditions, unless someone like China relents. And I don't see China relenting, because the higher the price goes, the more important it is for China to hang on to its silver, because it's not going to be able to replace it at anything like its original cost.
Precious metals do not behave like equities. Rising prices do not attract sellers. They eliminate them. Industrial buyers cannot wait for pullbacks. They must secure supply regardless of price. Mines are less willing to hedge forward, removing liquidity from futures markets. As physical metal is withdrawn, paper claims lose credibility. In this environment, short-term trading is dangerous. Larger players, governments, banks, and manufacturers dominate price action. History shows that in real commodity, bull markets, those who trade in and out are often left behind. Ownership, not timing, becomes the winning strategy.